In this video, we're going to look at Arista Networks, and this is a computer hardware company. And what I do in my videos is I look at the financial information for a company and try to figure out the true stock price. I also look at their financial ratios and compare them with its competitors. And I do this with you throughout the entire video, so it's like we're doing it together. Let's get started with the model. This company has a market cap of $17.7 billion. So it's a large cap stock. Let's get the stock price, $239.14. That's one share of stock. Next, we're gonna get the free cash flows. And the way you value a company is you estimate the future free cash flows, and then you discount that number back to today's value. And that's what I'm doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Now I'm going to pull the net income, which is the profit and loss on the income statement. And then I'm going to pull the revenue, which are the sales on the income statement. And look at their revenue increasing every year. That's a really good sign. They went from 1.1 billion in 3 years to 2.4 billion, more than doubled. And their free cash flow has been increasing as well. This company is definitely moving in the right direction. Their 2019 net profit margin was 36%. That's so much bigger than the previous years. Net profit margin is net income over revenue. It's how well the company converts its revenue into net income. The way to improve your net profit margin is to manage your expenses. Let's look at the capital structure of the company to get more information. They have no debt, which is awesome. Let's get the beta. The beta is how volatile the stock is relative to the market. And they have a pretty good beta, 1.15, so the stock moves a little more than the market. And the way to calculate the cost of equity is using the beta and the capital asset pricing model. Let's go back to the balance sheet to get their current assets. We need this to figure out the current ratio later, and that's 3.5 billion. And let's get their current liabilities. This is how much money the company owes within the next 12 months. That's 600 million. And their equity, 2.9 billion. That's assets minus liabilities. We also need their EBIT, earnings before interest and taxes. That's called operating income on the income statement. That's 806 million. And we need these numbers to calculate the ratios later. So the capital structure has no debt. They're 100% equity, and the cost of equity is 11.15%. That's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $15 billion. We divide that by 76 million shares, and we get an intrinsic stock price of $200. They're trading at $234, so they're trading at a 17% premium. It's a sell according to the model. Let's see what Simply Wall Street values the company at. They're pretty much where they're trading at. They're saying the stock is worth $234. So they're valuing it higher than I am. I'm using the prior financial information to value the company. Simply Wall Street uses what analysts say the company is going to be worth in the future. Let's look at the historical stock price. So it was trading under $100 a few years back. The price was driven up to about $280, and it's come down a little bit since then. But this company seems like it has a really bright future with no debt, really good financials, everything's improving. Let's look at their financial ratios. They have a pretty high PE of 20.6. That's price of stock, $234, over earnings per share. And earnings per share is $11.38. And you calculate earnings per share by taking net income over shares outstanding. I like to see below 15. If the stock price came down to 170, the PE would come below 15. It would provide a good value. Let's look at the price to sales ratio. That's 7.3. That's price of stock over sales per share. To get sales per share, that's revenue over shares outstanding. I'd like to see under 2.5. For this ratio to improve, they either need to increase their revenue or the stock price needs to go lower, or both. Let's look at the price to book ratio at 6.1. That's also kind of high. That's price of stock over book value per share. Book value per share is equity over shares outstanding. I like to see below 3.5. So another ratio they're not doing so great on. Their current ratio is 5.8. They can easily cover their current liabilities. If a company has a current ratio above 2.0, that usually means they're not running the most efficient operation. ROE of 30%, that's really good. I like to see above 20%. That's net income over equity. So they're providing their equity holders a great return on investment. The best way to look at ratios is to compare them to similar companies. I've done videos on Canon and HP, and these companies are in the same industry as Arista. And if Arista's numbers in red, they're worse than the average. If they're in green, they're better than the average. So they're worse than the average in PE, price of sales, but they're better than the average in price to book, current ratio, ROE, and debt. Even though HP has a really good price to earnings and price sales ratio, it could be because they took so much debt. When you borrow money, it does make it easier to generate more revenue and get more earnings. So if Arista took on more debt, it probably could improve these ratios, but I'd much rather have them at zero debt with these mediocre ratios than if they took on 50-60% debt and had good ratios. They're the smallest company of the three, but 17 billion market cap is not anything to sneeze at. So let me know what you think of the video. I think this is a great company with a great future. Thanks for watching.